Hi, Martin Turner here. This week, Maria Tyler leads our lecture as we look at the statement of cash flows, Maria's favourite financial statement. Maria introduces us to why we are interested in keeping a good eye on cash in a business. Maria also describes what cash is and how we look at cash flow from operating activities, investing activities, and financing activities. Maria also takes us through the two methods we can use to show cash flow from operating activities, the direct method and the indirect method. Let's start by looking at why we have a separate statement of cash flows.
Today we've got the statement of cash flows to go through, which is my favourite statement. But we have got a fair bit of heavy content to work through, and it's a popular exam topic, just saying. Okay, so ears open for this lecture. Ears open for all lectures, but particularly this one. So week 10, we're going through the statement of cash flows. I'm going to jump right into it. If you can log into your Echo 360 slides. If you can't see me or you can't see the slides, give me a yell out over the lecture. Okay, so our agenda for today, we'll go through the statement of cash flows. Why do we even have a statement of cash flows? We'll have a look at the content of the statement of cash flows in relation to the accounting standards. We will actually learn how to calculate cash flows from operations, including the direct and indirect ways of doing this. So there's two methods that we'll actually go through. Then we'll look at investing and operating activities, and we'll have a look at whether cash flows, well, our cash flow statement in Australia, if it includes GST or not. And you will be preparing a statement of cash flows. So by the end of today's lecture, you will know how to prepare a basic statement of cash flows. Then we'll finish off with the minute paper. Okay, so this is your first interactive question. Tell me if you've read Chapter 7 of the study guide. And it doesn't matter if you've read it or you haven't read it. I just want to know, to gauge how deep I need to get into the study guide in the lecture. So if you can click to the next slide. Have you read Chapter 7 in the study guide? I'll just show you on our unit page. Remember, we've got, so this is our unit's Moodle site. Study guide is on the left-hand side. So Chapter 7, it's the second last chapter in the study guide for our unit. Have you read it? This is Chapter 7. It's all about the statement of cash flows. So just let me know, have you read that chapter, or if you haven't?
Oh, Maria, Martin here.
Good morning, Martin.
Good morning. I was a bit slow setting up the slides. I only did it a minute or two ago.
Oh, okay.
On Moodle, so you could just check that people might need to refresh their Moodle site, or just check that everyone's been able to access the slides.
Okay. I might just quickly run through campus by campus and just see. So, Karen and Cairns, are you all right to access the slides?
Well, it's probably just everybody. If you're having trouble accessing the slides, just refresh your Moodle page and everything will be there.
All right.
We're just having a look, Maria.
Okay. We might just do what Martin suggested. So in the individual campuses, if you could just make sure that your students are refreshing their Echo 360 logins, and then they may be able to access it. I've got 3 responses so far, and it's overwhelmingly that no, you haven't read Chapter 7. That's okay. I will actually click into it and highlight sections actually that we go through today. My point being, you do need to read it. So Chapter 7 actually begins with a really interesting and amusing discussion about the wonderful world of cash, which is what we're looking at today. And I love cash, which is probably not the best thing to love, seeing as the Bible tells us that the love of money is the root of all evil. But anyway, I like the cash flow statement because it's hard to manipulate. All right, so we've got, so far, the overwhelming majority of people haven't actually read Chapter 7. So if you haven't, I will refer to it quite a bit today. Can you please make sure that you do read this chapter? It contains a lot of juicy knowledge and some really funny stories. Okay, so thank you to the couple of students that have actually read it before class. So why do companies prepare a statement of cash flows? Well, Chapter 7 of the study guide tells us that in business, there's only one way to go bust, just one way, and that one way is to run out of cash. So let me read one little paragraph that Martin's written in the study guide. I found it funny, apart from being a great explanation of why companies actually prepare a cash flow statement. So this is on page 3, by the way. So I'll actually open up Chapter 7 for you and go down to page 3. So for those who actually haven't read it, here's your first reading of a section of it. So what happens if we run out of cash and do not pay our staff in 1 week? What happens if staff find their salaries and wages have not been transferred into their bank accounts on the day staff are regularly paid each week or fortnight or month? Well, what happens is that things turn ugly, very ugly and very quickly. If I tell staff they can have an office chair this week for their salary instead of cash, they will look at me like I'm crazy. They will think Martin has really lost it. Cash is readily negotiable. Everyone accepts cash. Supermarkets, petrol stations, restaurants, coffee shops, insurance companies, indeed everyone. If I try to pay for my groceries at the supermarket checkout with an office chair, there will be trouble. The person at the checkout will look at me like I'm crazy, and I would be. So cash is central and critical to business, just as it is in our personal lives. That is why being able to manage our personal finances well is so freeing. Having our personal finances under control empowers us to live and can open up so many opportunities and reduce our worries and fears. It is the same in business. We need to keep a careful eye on cash. We need to plan and carefully use this most precious of assets. For this reason, we give cash its very own financial statement. This is why it is required in AASB 101 Presentation of Financial Statements, Paragraph 10, for firms to prepare a cash flow statement. So in fact, the statement of cash flows actually has its very own accounting standard. Okay, we call it AASB 107. And I'll show you on the AASB site. So just aasb.gov.au, I already went there. If we go back to the table of standards under quick links, and scroll down till you see 107, statement of cash flows, and click into that, it will bring you up with our specific Australian accounting standards. So AASB 107. This tells firms how they are to prepare and present their statement of cash flows in order to show the changes in a firm's cash balance over each period of time. Okay, so that's what our accounting standard for cash flows tells us. And I'll be referring to that quite a bit actually in today's lecture. Okay, so paragraph 10 of AASB 107 requires firms to prepare a statement of cash flows that classifies the cash flows into 3 different activities: operating, investing, and financing. Okay, so we'll be looking at those 3 sections today, and in particular we'll look at 2 different methods for calculating the operating cash flows. Now, the format of a statement of cash flows is cash flow from operating activities plus cash flow from investing activities plus cash flow from financing activities equals the change in cash for the period. Okay, so this is what we often refer to this as our net cash inflow or outflow, because each of these items can either be cash in or cash out. So we either get a net inflow or a net outflow for each of these activities. And when we sum those 3, and we will be doing that when we prepare our own cash flow from operating activities, we get a net cash inflow or outflow. So that's the change in cash for a period. We will be doing that today. We then add that to the cash at the beginning of the period, and that will give us the cash at the end of a period. Okay, so in this way, the statement of cash flows shows how the cash balances have changed during the period. The statement of cash flows sheds light on the question, how did our firm's cash balance change or move from its opening balance to its closing balance? And it shows us with the cash flows divided into these three activities. It also provides insights into the implications this might have for our firm's future cash position. Paragraph 6 of AASB 107 states that the cash flows in the statement of cash flows includes cash, cash on hand and demand deposits in the bank, and also cash equivalents, okay, which are short-term, highly liquid investments that are readily convertible to known amounts of cash and which are subject to an insignificant risk of changes in value. So it includes cash and cash equivalents. And cash flows are inflows and outflows of these items. Okay? So cash equivalents are basically assets that can be turned into cash quickly without any real risk of loss, in plain English. Now, remember the three categories that the standard requires in paragraph 10. Well, these three categories are defined earlier in paragraph 6. So let's actually go to paragraph 6 of AASB 107. I'll scroll down. They're set out in paragraphs, not pages. We often refer to just the paragraphs. So the paragraphs are on the left-hand side. So in the definitions in paragraph 6, you can see the three categories defined here. So we've got operating activities are the principal revenue-producing activities of the entity and other activities that are not investing or financing activities. Investing activities are the acquisition and disposal of long-term assets and other investments not included in cash equivalents, and we looked at that definition just before. And financing activities are activities that result in changes in the size and composition of the contributed equity and borrowings of the entity. So remember, we're talking, actually we'll cover equity next week in week 11. We'll look in more detail about debt and equity items then. So financing activities are to do with those items. Now we'll look at these three activities today in more detail right now. Okay, operating activities. So this is the first one. They're extra special because the standard allows firms to choose between another two methods of presentation called the direct and indirect methods. You will need to know these methods, and I'm going to go through today and show you how to calculate cash flows from operating activities using the direct method and the indirect method with the same example, same set of figures. Okay, let's go to paragraph 18 of the standard, and this is where the blue speech bubble here has been taken from. So if we scroll down to paragraph 18 in the nice bold, it states that an entity shall report cash flows from operating activities using either the direct method, whereby major classes of gross cash receipts and gross cash payments are disclosed, and we'll look at those classes very soon, or the indirect method, whereby profit or loss is adjusted for the effects of transactions of a non-cash nature, any deferrals or accruals of past or future operating cash receipts or payments, and we look at those on the balance sheet, and items of income or expense associated with investing or financing cash flows. And again, I'll look at that and show you how we calculate that very soon. In paragraph 19, the next paragraph, the accounting standard goes further and particularly encourages firms, but does not require them, to use the direct method. So entities are encouraged to report cash flows from operating activities using the direct method. Okay, so this you'll probably find is preferred by the standard, so your companies may use this more often. but the standard allows both methods to be chosen and presented. And in practice, you will find many of your firms will use both the direct and the indirect method. Often they will use the direct method to set out their statement of cash flows and will include the indirect method in a footnote. So many of your firms will effectively give two forms of statement of cash flows. One as the statement of cash flows itself, usually using the direct method, and the other by way of footnote, the indirect method. So my company, Wes Farmers, does that. Okay, we will look at each of these methods in more detail today. And when we do, you'll see that the direct method provides information that is not available in the income statement and balance sheet, namely major areas of cash receipts and payments in the year. And the indirect method reconciles the operating profit and cash flows from operating activities by adjusting profit in the income statement for the non-cash items and accruals. So we will learn to calculate both of those methods today. So we'll learn to calculate cash flow from operating activity. Now, next slide, big shout out to the next slide. I want you to keep this slide really handy for your tutorials and for your exam study. Okay, so big hint, hint. You might also find it useful to keep pages 7 to 10 of the study guide, chapter 7, handy as well, because it also tells you how to calculate cash flows from operating activities using the direct method there. So this slide plus pages 7 to 10 of the study guide, so our wonderful study guide, chapter 7. Keep them handy. These resources tell you exactly how to prepare the cash flow from operating activities using the direct method. You will need to know how to do this. Not maybe, you will need to know. So let's go through an example now. I've tried to make this example a very streamlined example and, so that it's fairly painless to go through. But what I will do is explain the logic first of what I'm doing, and then I will switch to the document camera and use my pen and paper and just show you how I will do it again, showing you manually how I'm calculating it. Because in my Echo 360 slides, I can't figure out how to get like the little pen thing happening like you can in a normal PowerPoint presentation. Okay, so here's our example, and we're going to use this example with a couple figures extra for when we prepare the indirect method. So we've got Maria Limited with a balance date at 30th of June. We've got two sets of figures. We've got this year's 2019's current year's figures plus a set of comparatives for 2018 for just a few items: cash, accounts receivable, inventory, accounts payable, and salaries payable. And in addition, during the year, we've got 4 other items. So we've got credit sales of 6,000, cost of goods sold of 4,000, wages expense 1,100, and other expenses 1,500. And using the direct method, so we're doing the direct method of calculating operating activities, so cash flow from operating activities, we have to calculate the cash flows from operating activities for Maria Limited for the year ended 30th of June 2019. So remember in the previous slides I said we will learn about the categories of cash flows that we can calculate. So I'm going to lump 3 different categories on you. So we've got cash receipts from customers, payments to suppliers, and then payments for all other expenses. So they're going to be the 3 categories that we calculate. So start with your cash receipts from customers. Okay, so you can write that down as a heading, cash receipts from customers. Now, we literally are trying to figure out or calculate from these figures what cash our customers have given us. Okay, so what cash have we received from our customers? So the logic behind that is we start with the opening balance of our accounts receivable. Okay, so these are the customers who have paid us on credit. And we start with the opening balance because hopefully you've collected all of their money, that opening balance money, by now. Okay, by the end of the year, hopefully we've collected all of the $400 that was owed to us at the beginning of the year. So we start with that figure. Then we add the credit sales that we've made during the year, okay? And then we take off the ending balance of accounts receivable, because obviously those people haven't paid you the cash yet, otherwise they wouldn't be sitting there as accounts receivable. Okay, so that's the logic behind calculating your cash receipts from customers. So we start with the opening balance. We hope we've collected that 400. We add to that the credit sales we've made during the year of 6,000. But then we take off the closing balance of accounts receivable, because they obviously haven't paid us the cash, because that's why they're sitting there as an accounts receivable. Okay, so we take off that balance because we haven't got that cash yet. So we add those figures, 400 plus 6,000 minus the 300. Okay, and we get a net cash inflow of 6,100. I will show you manually next. I'm just explaining the logic behind what I'm doing. Okay, so that's calculating cash receipts from customers. Calculating payments to suppliers. So that's your next heading. So payments to suppliers. We're calculating that figure. Now, this isn't just a matter of using the cost of goods sold figure, okay, as we looked at in week 5 when I did the lecture on inventories. You have also got to account for balances in the inventory current asset account as well as accounts payable, because both of those accounts also affect the cash paid to your suppliers. Now, cast your mind back to week 5 on inventories, because we're talking about inventories now, and remember the cost of goods formula from week 5. So the logic I presented, and I think I used the diagram of piles of gold, and I drew it using the document camera, and I said, okay, your cost of goods sold equals the opening inventory that you had on hand, plus the purchases that we made, minus what the stock we have remaining that we haven't sold yet. The difference has to be the cost of what we have sold, so the cost of goods sold. That was the formula I presented. Well, you can use that here now in terms of inventory, because that's already accounted for in the cost of goods balance of $4,000. So in English, you basically have to do the opposite, i.e. minus the opening balance of inventory and add the closing balance of inventory, okay? So that's how we account for the inventory. So we minus the opening balance and we add the closing balance, because you've already accounted for it in that cost of goods sold formula that we looked at in week 5. Okay, then we calculate the change in accounts payable. So the formula for this and the logic is the same as that for accounts receivable when we calculated the cash receipts from customers, i.e. we add the opening balance of accounts payable, because hopefully you've paid all of your suppliers their money by now from the beginning of the year. Otherwise, you'll be in very bad credit terms with them. Okay, so we add the opening balance of the accounts payable, and then we take off the ending balance of accounts payable, because obviously you haven't paid the cash to those suppliers yet. Otherwise, they wouldn't be sitting there as an accounts payable for you to still pay. Okay, so you can start with the cost of goods sold, then add the inventory closing balance, take off the inventory opening balance. Okay, remember this bit is just to account for the purchases made to suppliers, i.e. reversing the formula that we looked at in week 5. Then we add the opening balance for accounts payable and deduct the closing balance for accounts payable. Okay, so if you do that mathematically, you have your 4,000 plus 500 minus 750 plus 600 minus 650. So you'll actually get an outflow. Okay, so a negative 3,700 outflow cash from payments to your suppliers. Okay, so payments to suppliers is 3,700 outflow. So that's the second category we've calculated. The third category is the payments for other expenses. And again, there are a couple of steps here. So firstly, we've got to look at what other expenses we have. So we've got wages expense, and we've also got salaries payable in the information given. And then we've got other expenses. Okay, so firstly we have to account for the wages and salaries and then add that to the payments for the other expenses. So add that to the 1,500. Thankfully though, the logic for the payment to suppliers is similar to that for the accounts receivable and accounts payable, i.e. we're actually going to add the opening balance of salaries. Okay, so we've got salaries payable here. We're going to add the opening balance of salaries because hopefully you've paid all of your employees their wages in cash by now. Otherwise, they'll be really cranky with you and they probably will have quit. Okay, so we're going to add this because we've actually paid that in cash. And then we're going to take off the ending balance of salaries because obviously you haven't paid the cash to those employees yet. Otherwise, they wouldn't be sitting there as being payable for you. Okay, so we haven't paid that cash, so we add and subtract. So we start with the wages expense during the period. We then add the opening salaries payable and minus the closing salaries payable. Then add the other expenses in of 1,500. So 1,100 plus 150 minus 400 plus 1,500 equals a $2,350 outflow. So that's cash that we have paid for other expenses. Then, to calculate total cash flow from operating activities, you sum those three categories up. So the 6,100 inflow minus the 3,700 outflow minus the 2,350 outflow, and you will get 50. So $50 cash inflow from operating activities. Now I'm going to go through that again, so don't freak out because that's the first exposure you've had. And I'm going to do this manually. So if you can keep this slide open so you can see the figures on your computers, I'm going to switch to the document camera and zoom it in and write on this slide. Okay, so you can see my workings manually. Okay. Hopefully it is a little bit blurry. That's why I do require you to have your slides open or print it out if you print them out. And if you're looking at this, if you're watching this back again, make sure you print them out before you watch it back so you can actually see what I'm doing manually. Okay, so there's three categories, so I'm going to try and squish them in on this slide. So cash, receipts, from customers, that's our first category, okay? That's the first one that we're calculating. Put a dot point there. Then we're going to calculate, this is our structure. Payments to suppliers. And then the third one is our payments for other expenses. Okay, so we are calculating, the whole idea of this slide, remember, is we are using the direct method to calculate the cash flow from operating activities for the year ended 30 June 2019. So we're not doing investing activities or financing activities or the indirect method. All we are doing is calculating cash flows from operating activities using the direct method. These are the three major components we're going to group our figures into. Okay, so cash receipts from customers, that's going to be hopefully an inflow. Payments that we made to our suppliers in cash, and payments for all other expenses, two outflows of cash. How we calculate this, I explain the logic using our accounts receivable and our credit sales, okay? So the figures that we have to use to calculate the cash receipts from customers are the accounts receivable balance sheet item, opening and closing balance, and we have to calculate the difference. We're going to add the opening and minus the closing, and we're also going to include our credit sales. So the logic was, we've received all this money from our, we've received all the cash from our customers. Hopefully we've collected it all. So we add the 400 in. We also add the sales we've made, the credit sales we've made for the year, and we take off the people who still owe us money who haven't paid the cash yet. So hopefully we've received that in cash. We've received this in cash minus the people who haven't paid this the cash yet. So I'll just move this over so I can show you my figures. So it's the 400 opening balance plus the $6,000 credit sales minus the 300 closing balance. And I like to write inflow in my workings, okay? So cash receipts from customers, 400 plus 6,000 credit sales minus 300 closing balance equals 6,100 inflow. That's the first category. Payments to suppliers. Similar logic, but we have to include a few other figures in here. So we have to reverse. We can't just take this cost of goods sold. We're going to start with that figure, all right? So we're going to start with the cost of goods sold, but we can't just rely on this because we've actually already accounted for inventory, remember, using that cost of goods sold formula that we actually looked at in week 5. So we have to reverse that formula out, all right? So we have to add the closing balance and minus the opening balance. So we'll start with the 4,000 cost of goods sold. I'm going to move it over again, so 4,000 in here, which we've paid in cash, we assume. Account for the inventory, that's in the formula for calculating cost of goods sold. So add in the closing balance for inventory, take off the opening balance. Okay, so these figures, I'll just point out again, is my cost of goods sold that I've paid in cash, plus the 500 closing balance, minus the 750 opening balance for inventory. So that's in the inventory item here. So I can tick the accounts receivable, tick the inventory. I've accounted for both of those. And now I have to do the same logic for accounts payable that we looked at for the cash receipts from customers, okay? So we have to add the opening balance of accounts payable and take off the closing balance of accounts payable. Remember, because hopefully we've paid all of the cash to our suppliers by now, otherwise they'll be cranky with us. And we haven't paid this in cash, so we have to take that off. Okay, so again, add the opening balance, which we have paid in cash, take off the closing balance. What was the closing balance? 650. So when I put that into my calculator, the 4,000 cost of goods sold plus 500 minus 750, accounting for inventory, plus 600 minus 650, accounting for the accounts payable, I get 3,700. And that is a cash outflow. Okay. So that's 2 categories done. The last category is payments for other expenses. Okay, so again, a couple of figures that we have to refer to. So you can see I've ticked off accounts receivable, inventory, and accounts payable. So we know we've got to still account for the opening and closing balances of salaries payable. And we've also got, so we've dealt with that one, we've dealt with that one. We also need to deal with the wages and the other expenses, okay? So again, the logic is similar as the cash receipts from customers and the payments to your suppliers. So we add the opening balance of salaries because, again, hopefully we've paid all of our employees their wages by now. So we're adding this in cash. We've paid that in cash, so add it in. And we take off what we still owe our employees for salaries at the end of the year, okay, because they wouldn't be sitting there as salaries payable if we'd paid it in cash. Okay, so add the opening balance, take off the closing balance. So start with your wages expense, and then add the opening balance, take off the closing balance, and add in your other expenses. So we've got, moving over again, the 1,100 wages expense, add in the opening balance, which we've paid in cash, take off the closing balance, which we still owe to our employees, and then add in the other expenses we've paid in cash during the year. When we put that into my calculator, we'll get 2,350 outflow. Okay, so they're my 3 categories. So I've got a $6,100 cash receipts from customers as an inflow. I've got an outflow of 3,700 payments to suppliers. and I've also got a $2,350 outflow payments for other expenses. So if I sum those three figures, 6,100 minus 37 minus 2,350, so I'm going to write that here, 6,100 minus 37 minus 2,350 equals $50 inflow from operating activities. Woohoo, Maitland says. Really killing it here in Maria Limited. All right, so that's the direct example. Okay, so they're the three categories. Now, I'm just going to flick back to my slides. Has everybody, yeah, finished? All right. If you need these again, don't worry, it's recorded, so you can watch it again. All right. So, we've been given a set of figures. We have now calculated, I have shown you how to calculate cash flows from operating activities. Now, don't worry if you don't understand the logic, which I talked through a number of times. That's okay. There are people who need to understand why and how they're doing something, and that's why I explain the logic. And then there are people who just want to memorize the formula, and that's fine too. If you're one of the memorizing people, just, okay, Maria said add the accounts receivable closing, opening balance minus the closing balance, and add that to credit sales. That's how I get my cash payments for from customers. That's fine. Just remember the formula. It will still work for you. If you don't understand the logic behind it, just remember the formula. So if you're one of the people who like to understand why you're doing something and talk yourself through it, then that's good, because I've just done that for you. If not, and you just want to remember what to add and what to minus, then again, I've demonstrated that for you. Just memorize the pluses and the minuses and which way they go. That's the direct example. All right, moving on. We're going to go to the indirect now. Remember, we're still stuck on operating activities. We haven't moved on yet. We're still under the operating activity category. We haven't moved to investing or financing. So we're just calculating the operating activities, cash flow from operating activities, using the direct and indirect methods. Is that full screen? Yeah, there we go. Okay, so the indirect method is usually shown in the notes to the accounts, and it reconciles the operating profit to cash from operations, so cash from operating activities. Okay, so the indirect method, this next slide, shout out again to the next slide. Okay, this slide here. I want you to keep this slide really handy for your tutorials and right now as well, and also for your exam study. And you might also find it useful to keep pages 7 to 11 of the study guide, chapter 7 handy as well, okay? Because these resources tell you exactly how to prepare the cash flow from operating activities using the indirect method. Okay, you will also need to know how to do this. So, this little structure here, if you've managed to print the slides out before class, will be really good because now you can scribble all over them. Okay, we're going to use this structure, and I'm going to explain how to fill in the figures in this little structure on the slide. In our next example, which uses this, well, the same company, so we're looking at Maria Limited again, with a few extra bits of information, and we're going to learn how to calculate the increases and decreases and where they get put. So this is your little structure for calculating cash flows from operating activities using the indirect method. We start with the operating profit after tax, then we add back the non-cash expenses such as depreciation or a loss on sale of assets. We take off the non-cash revenue such as a gain on the sale of assets. We then add a decrease in our current assets, add an increase in our current liabilities, take off a decrease in our current liabilities, and take off an increase in current assets. Okay, so that's the formula. Now, I will talk you through how we get those and how we determine what's an increase and decrease in the example that we're going to go through now. But essentially, add all of those figures together, and that will bring you back to the cash flow from operating activities using the indirect method. So we already know we've just calculated it using the direct method, so it's got to be 50, right? So we're now going to do it using the indirect method, and hopefully we'll end up at 50 again. Okay, so here's our example. So we've got our cash, accounts receivable, inventory, accounts payable, and salaries payable again. In addition, during the year ended 30th of June 2019, we've got profit after tax, because we're going to need to know that, 900, depreciation, which is a non-cash expense, 500, and a gain on the sale of assets of 2,000. Okay, so now we've covered these concepts when we looked at non-current assets, and I did the lecture on that as well. So you should be familiar with these items as being non-current, as being non-cash. So using the indirect method, we have to calculate the cash flow from operating activities for Maria Limited for the year ended 30th of June 2019. So using this structure, okay, this is your little structure, and what I've done in advance, because I thought it might be a bit easier, is actually put in the notes to this slide, and you've got access to those, the figures, the dollar figures next to it. So you can just keep this slide open. I'm going to flick to the document camera again and show you where I'm getting the figures from, but first I'll talk you through it. So the operating, so again, you're looking at this slide, okay, so you can see what I'm going down. Operating profit from tax we're starting with. We were actually told that. So simply put in $900 right next to this line here. Operating profit from tax, write down 900. Okay, then we're going to calculate or have a look at what non-cash expenses we have. So have a look, do we have depreciation? Do we have a loss on sale of assets? Well, I can see we've got depreciation here, so you can put $500 next to that item. And I can't see any loss on sale of assets that I've been told in my information. So just the 500 goes next to this line item here, non-cash expenses. So we've got is 900 here and 500 here so far. Now we'll look at, see if we've got any non-cash revenue. So let's go and see, have we got a gain on sale of assets anywhere? Yes, we do. The extra information told us we've got a gain on sale of assets of $2,000. So plonk that 2,000 next to this line item here, non-cash revenue. We've got $2,000. Don't worry about whether it's plus or minus at this stage, just write the figures down. We'll use this little formula on the left-hand side to guide us. Okay, now we have to actually go and calculate the increases and decreases in our current assets and liabilities. So we'll go and calculate them first, and then we will come back and fill where they've got to go, whether it's a decrease in current assets, because we don't know yet, we haven't calculated it. So let's look at the comparative information we've been given here. So we've got accounts receivable. Next to this item here, well, next to each of these, we're going to calculate and indicate with an arrow whether it's an increase or a decrease, okay? So I'm going to switch back to my little document camera. And sorry it's a bit blurry, but hopefully you've got the slides in front of you. So accounts receivable, we started off with $400 at the beginning of the year. We've now got $300. So that's a decrease, right? So do a little arrow. See if I can zoom this a bit more. Still blurry. Anyway, so do a little arrow, decrease 100. Okay, let's do inventory next. We started off with 750 at the beginning of the year. We've now got 500. So that's a decrease. We're going down. Okay, so we started with 750. We've only got 500. So again, draw a little down arrow. So we've got a decrease, and the difference is 250. So it's a decrease of 250. Let's look at accounts payable, all right? So we started off with 600. We've actually got 650. So in this case, it's an increase. So draw a little up arrow for increase, and it's increased by $50. And then salaries payable, we started off with 150. We've now got 400. So it's also an increase, and it's an increase of 250. Okay, so is everybody following my logic on how I determine what's an increase and decrease? Look at what you started with and when you add it up and go, Has my figure gone up or has it gone down? And draw your little arrow and then just write the amount there for you. Now, you also need to draw on your knowledge of what is the current asset and what is the current liability. So we know that cash, accounts receivable, and inventory are our current assets, okay? So I like to put a CA next to those, or you can just write current assets to remind you. Accounts payable and salaries payable, they're our current liabilities. So now we've got the information, we know whether we've got an increase or a decrease. So flicking back to our little structure for calculating the indirect method. Now we can say, now let's go and have a look in our current assets. Do we have any decreases? And then plonk them in. So do we have a decrease in current assets at all? Can anybody see on our little pieces of paper? I need to go back to my document camera. So looking at our current assets, okay, do we have any decreases? Well, yes, we've actually got 2 decreases. So we're going to add both of those figures in, 100 and 250. Okay, so flicking back to the computer. So under this section here, decrease in current assets, we want to put 100 plus 250 right next to this line. And so we already know there's no increase in current assets because we don't have any. So we can just leave that blank, or you can just put 0 there. It's up to you. So we've checked our current assets. Both of them are actually decreases. So we put the 100 plus 250 there. Now let's go and have a look at our current liabilities and see if we've got increases or decreases. So our current liabilities are here, accounts payable and salaries payable. Oh, we've actually got 2 increases. So we don't have any decreases in current liabilities, but we do have 2 increases in current liabilities. So the 50 plus the 250, you can plonk right next to this line. Increase in current liabilities, 50 plus 250, right here. And we don't have any of these 2. We don't have a decrease in current liabilities, and we don't have an increase in current assets. So now we've got figures, and we can simply just do the maths. So operating profit after tax, 900. I'll flick to my document camera because I've actually got it listed here for you. We can check that you've been writing it correctly. Okay, so we've got operating profit after tax, 900. We're going to add, it tells us to add the 500, depreciation. Take off our gain of sale on assets of 2,000. Add the 100 and the 250. Add the 50 and the 250. We didn't have any of these. So when we put all of those into our calculator, so 900 plus 500 minus 2,000 plus 350 plus 300, we should get back to our cash flow from operating activities of 50. Okay, so that's the indirect method. You need to calculate and figure out which categories your increases and decreases go to and fill in all of the additional information. That's probably the hardest part of today's lecture. All right, we've just been through it. So you've come through the hill. We're on the downhill run now. Now, I've been through it in such detail because, like I said, it's very popular for the exam topic. So you've now got tools you can use for your study. That is calculating cash flow from operating activities only using the direct method and then the indirect method. Okay, so that was calculating cash flow from operating activities, 2 methods. Calculating cash flow from investing and financing activities are basically the same as the direct method for calculating cash flow from operating activities, okay? So with changes in the cash flow from investing activities, we look at the changes in non-current assets. So remember in week 8 when I did the lecture on non-current assets, non-current assets are those where we expect to gain a future economic benefit in the longer term, post 12 months. These benefits can relate to periods many years in the future, so at least more than 1 year in the future. So this means that a firm invests into its non-current assets with the expectation that they will provide benefits to the firm in the longer term, or in other words, Cash is being locked up into non-current assets in the firm with the expectation of growing its cash flows from operating activities in the future. Okay? So in the study guide on page 7 of the study guide, page 7 of chapter 7 of the study guide, we see in the consolidated statement of cash flows of Ryman Healthcare that it had cash flows from investing activities of negative $525.8 million. So that's figure 7-1 in section 7.3 of the study guide. These investing cash flows related primarily to the purchase of property, plant and equipment and intangible assets, so negative $192.4 million, and the purchase of investment properties, which was negative $314.9 million. Okay, so for Ryman Healthcare, property, plant and equipment are primarily its aged care facilities, including any aged care facilities that were currently being built. So it has spent a large amount of property development in a year, okay, into its non-current assets. That's its investing activities. Now, Martin also discussed other activities, other investing activities that he covered in the study guide of Ryman Healthcare, which included capitalised interest paid, which was interest paid on the loans that were used to fund some of their property development in these non-current assets. Advances to employees, which were amounts loaned to employees to fund the purchase of shares in Ryman Healthcare for staff as part of its employee share ownership scheme. So the point about my slide, why I'm referring to chapter 7 of the study guide is make sure that you read through the section on cash flow from investing activities, because you will need to know how to interpret a cash flow statement, okay? So, for example, you may be asked to comment on a given statement of cash flows in the exam, and you will need to be able to tell the story behind it. So for investing activities, it's not necessarily a bad thing to have a negative cash outflow for investing activities, because as Martin has shown in chapter 7 of the study guide, Ryman Healthcare is investing into its non-current assets with the future expectation of growing cash flows from operating activities. Okay, so if we are investing in our assets to generate us higher cash flow in the future, it's not necessarily a bad thing. So if you've got negative cash flow from investing activities, just look at why. Okay? Cash flow from financing activities. To calculate the cash flow from finance activities, we need to look at the changes in equity and borrowings. And equity and borrowings are going to be covered in depth next week by Martin in the lecture for week 11. This section, the cash flow from financing activities, tells you how a firm is financing its operating and investing activities. It tells you how it's generating the cash flows that you've just calculated from operating and investing activities. It's important to make sure that you can also explain this section, okay? Chapter 7 provides a great example for you to follow. Martin discusses how Ryman Healthcare produced a strong cash flows from operating activities, but invested much more than this into increasing its non-current assets, principally through developing new retirement village units and the accompanying community facilities and new care facilities as well. Okay, so that's what Ryman Healthcare did. It produced strong cash flows from operating activities, but then it went and invested that plus a whole lot more in its investing activities. So how did Ryman Healthcare fund this difference? The answer is through its cash flow from financing activities. Okay, these are the result of its interactions with the capital markets. Ryman Healthcare financed its negative cash flows from investing activities through bank loans. Also, it paid dividends to its shareholders of $85 million, and it purchased some of its own shares for an employee share ownership scheme for $4.6 million. These are all aspects of financing activities. Again, generally, it's not a good or bad thing to have negative cash flow in this section. You need to look at the story it's telling. If they've got negative cash flow, it might mean that they're repaying their loans, which may be a good thing. If they've got positive cash flow, it might mean that they're borrowing lots of money, which again, may not or could be a good thing. We don't know. In Ryman Healthcare, it's telling us the story of Ryman Healthcare financing its negative cash flows from investing activities through borrowings. Okay, so tying all of those three sections together, operating, investing, and financing, what story is it telling? So remember this slide earlier, I had up this in the box, we looked at this earlier today. We have looked at each of these activities and seen that together, these calculated cash inflows and outflows tell us a story of what's happened with the cash balance over that period. Okay, the cash at the end of the period should match that same cash balance that is sitting in current assets on your balance sheet as at the end of that same period. So tying it into our interactive financial statements, one of the checks of our financial statements linking and flowing through each other is, does the cash at the end of the period in the statement of cash flows match the cash as presented in the current assets section of the balance sheet? Okay, so that's one of the checks. So what story is it telling? In Chapter 7 of the study guide, you can see from the example of Ryman Healthcare's consolidated statement of cash flows that the company has strong cash flows from operating activities. It's investing substantially more than this in growing its non-current assets. It is funding the difference through a substantial increase in borrowings. It is also funding its dividend payments to shareholders through its increase in borrowings. That is the story that it is telling. Phew, we've been through a bit now. So I'm going to wake you up now. I want you to click into your interactive slides. Time to wake you up with a bit of a note on GST. So go to your interactive slides and tell me if you think that the cash flow statement includes or excludes GST. And it doesn't matter if you get it right or wrong. I just want your thoughts. Do the items in the cash flow statement generally include or exclude GST? So click into that and let me know what you think. All right, let's have a look at 8 submissions. Oh, they're fairly even. This is interesting. So are they inclusive? Are they exclusive? So we know from previous weeks that the figures on financial statements are generally exclusive of GST, right? Except for, accounts receivable, accounts payable, and the 2 GST items on the balance sheet. Well, in Australia, the items in a statement of cash flows are inclusive of GST. Maitland's like, yeah, I got it right. Okay, but having said that, Maitland, not all countries do that. So Ryman Healthcare in New Zealand doesn't. So yeah, so I'll go through that now. So in Australia, the items in a statement of cash flows are inclusive of GST, such as with my company, Wesfarmers, right? But this may not always be the case for firms in other countries, such as the case of Ryman Healthcare. Now, GST Interpretation 1031, called Accounting for the Goods and Services Tax, is an Australian interpretation from the AASB, the Australian Accounting Standards Boards, dealing with the accounting implications of GST. And this is where we're told that in Australia, our statement of cash flows have to be inclusive of GST. I'll just minimise this. Get out of these for a minute. Let's go to aasb.gov.au, go back to the home page, because you can also access the interpretations. So you can access the table of standards and the table of interpretation. So let's go down to GST Interpretation 1031, which is like way down here. Okay, accounting for the goods and services tax. And in paragraph 10, here we go. Let me zoom this in a bit. We're told, this is GST Interpretation 1031, paragraph 10, we're told that cash flows shall be included in the statement of cash flows on a gross basis, i.e. GST inclusive basis. All right, so AASB interpretations have the same authority as accounting standards in Australia. So we can expect that with Australian firms at least, items in the statement of cash flows will be on a GST inclusive basis. Okay, and Martin does cover that in Chapter 2, Section 2.2, page 2-6 of the study guide as well. Having said that, as I just mentioned before, for our firms in countries other than Australia, there can be exceptions. For example, Ryman Healthcare, which is a New Zealand-based company, shows its statement of cash flows exclusive of GST. And it actually states that in its 2017 annual report on page 29 in the summary of significant accounting policies. It says the statement of cash flows is prepared exclusive of goods and services tax, which is consistent with the method used in the income statement. Okay, so just be aware that for firms in other countries other than Australia, they may present differently. In Australia, though, items in the statement of cash flows are inclusive of GST, such as with my company, Wesfarmers. All right, so I think I just skipped over one, yes. So we have been through a bit of heavy content today. Now, you will get opportunities in your workshop to further consider the differences again between profit and cash flow, and you'll also be able to prepare a statement of cash flows using the direct and indirect methods, all right? Even if you just have to work through my slides again in class with your local lecturers and tutors, that's fine. Okay, that's actually a really good thing to do. So if you need some more help with understanding and we don't have access to the recording right now, but later on you'll have access to the recording again, but you've got your local tutors and lecturers and they'll be able to actually work through the examples I covered in the slides today. So let's move to the minute paper. Oh, before I move to the minute paper, shout out to the big Have Your Say button on our Moodle site. So please take 2 minutes or 5 minutes or 20 minutes if you like to give us lots and lots of feedback. We like to know what you think about our unit. So please can you make sure that you fill in the Have Your Say button for us so we can read your comments and work to improve the unit. Okay, I'll mention that again at the end. Minute paper. What was the most important thing you learned today and what questions still remain unanswered? So I will time you for a minute. If you can please go to the interactive section here, type in the most important thing you learned today and then ask me some questions and I'll do my best to get through them in the next 20 minutes for you. So ready, set, go. I've got a few responses now to go through with the most important thing that you learned today. So thank you for sending those through. Keep them coming in. I'll keep going through them. And while I'm going through them, if you think about questions that you want to ask me, pop them into the next slide as well. So keep that open, and as we're going through the previous one, pop them in and then we can go through the questions. I haven't got any at the moment, no questions. Okay, so what was the most important thing you learned today? Calculating with the direct and indirect methods. That in Australia, GST is inclusive on the cash flow statements. However, other countries such as New Zealand do not have to. That's a good takeaway. Memorise how to calculate the direct and indirect method. How to calculate direct method and indirect method in cash flow. Well, that statement's not, these statements aren't very specific. Direct method and indirect method in calculating cash flow from operating activities. Okay, so those two methods relate to calculating cash flow from operating activities. So this is the next comment: calculation of cash flow from the operation. I've been reprimanded by Martin for my terms, so I have to remember to refer to them as operating activities. Okay, not from cash flow from operations. And I noticed on my slide there were a couple of mentions of operations, so I apologise for that. It should be cash flow from operating activities. Calculating the cash flow from operating activities using the direct and indirect method. Very good. That each method should end up at the same figure after completing the appropriate calculations. Yes, so you should, regardless of which method you are using to calculate cash flow from operating activities, you should end up, so either the direct method or the indirect method, doesn't matter, you should still end up with the same figure, okay? The most important thing I learned today was how to calculate cash flows through the direct and indirect methods. Okay, so good. With our final exam coming up, it is important to know this and be able to calculate cash flows using both methods. Yes, that is good to know. That's a good takeaway. I thought I just mentioned the exam at the beginning, you know, it's a popular exam topic. Difference between direct and indirect method and how to calculate cash flow from operating activity by using these methods. The meaning of cash flow from all the activities. Good. So the meaning of cash flow from all the activities, what story is it telling you? That's tying it all together. And that's really important to do because if you are presented with a cash flow statement, you then will need to interpret it or tell the story of that cash flow statement through each of its activities. So always categorize it into the structure that we've shown you today, so the operating, the investing and the financing, and then make sure that you are discussing the story in amongst those categories, those activities. Okay, the three categories in direct method to calculate operating activities and the indirect methods. Okay, so this statement's not quite correct. We looked at the three categories that cash flows are presented in. So the statement of cash flows presents three different activities: operating, investing and financing. Within that first activity, the operating activities, we looked at two different methods, which the standard AASB 107 allows us to calculate the cash flow. So how to calculate the cash flows from the first activity, the operating activities, we looked at the direct method and the indirect method. So two methods to calculate cash flows from operating activities. And then we looked at interpreting cash flows. So the study guide shows you how to calculate the cash flows using Ryman Healthcare's example, and then interprets the story behind investing and financing activities. Okay, so that's what we looked at today. Very good. Okay, so we'll move on to some of the questions that still remain unanswered. Okay, so what does cash flow from investing activity means? I might see if somebody else in the teaching team might like to answer this, because I've obviously given you my interpretation of what it means, and I went through that it's the company investing in assets to generate hopefully future operations. But would anybody else from the teaching team like to explain in their perspective, what does cash flow from investing activity? I can run through mine again. Mine's basically the changes in current assets, okay? So changes in the cash flow from investing activities. We look at the changes in non-current assets. So in week 8, we learnt about what non-current assets are. Okay, they are the assets that we expect to gain future economic benefits in the longer term. So those benefits can relate to periods many years in the future. We hope at least more than 1 year in the future. So if a firm invests into its non-current assets, it usually does that with the expectation that they will provide benefits to the firm in the longer term. In other words, we lock our cash up into the non-current assets in the firm with the expectation of growing cash flows from operating activities in the future. Okay, so investing activities are anything that the firm's spending money into or receiving cash from. Non-current assets, so we are paying money for new assets, or we are selling off our assets, in which case that would be a cash inflow. If we sold off our assets, we would be receiving cash, so you'd have a cash inflow. If we are investing into our non-current assets, so our property, plant and equipment, you would have a cash outflow in investing activities. Okay, so you have to look at what the firm is doing, and that's why I said in investing activities, if it's negative, it's not necessarily a bad thing. If you have cash outflow, it's not necessarily a bad thing because you could be investing for the future. I have a question. So your mic's on.
With the cash flow from financing activities, I just noticed it said changes in non-current liabilities and equity, and it had issue of shares. Does share buybacks have anything to do with that as well?
Yep, surely does. And Ryman Healthcare's actually, in Chapter 7 of the State Guide, had some of its share buybacks from its employee share scheme as well. Definitely. Anything to do with cash.
Yeah.
So if you are spending the cash to buy back shares, that will be a cash outflow.
Yeah.
So it's sort of some of the logic you have to talk yourself through with investing and financing is cash going out or is cash going in, which sometimes is a little bit different to, is it a liability or is it not a liability? So for example, with a loan, when you get a loan from the bank, it increases your liabilities and also increases your cash, right? Now, a loan is a financing activity. So that's what Ryman Healthcare is doing. They're actually increasing their loans. But is that a cash inflow or an outflow? Is getting a loan, does it give you cash or are you paying out cash? You're getting cash. Yeah, see how the concept with because a liability is like, oh no, it's an obligation to pay. So we think liabilities paying cash. But in terms of a cash flow statement, when you get a loan, the bank gives you the money. So you've got to think about it in terms of cash flow, not is it a liability, the definition of a liability. So, financing activities, so borrowings, share issues, they will increase, so they will be a cash inflow. They'll increase cash because the bank is giving you money and also your shareholders are giving you money. So share issues, new capital raised, loans from a bank, they will be positive cash flow.
Right, so if you were lending money,
yep,
it would be down, like it would be negative because you're giving it money.
If you're repaying your loans, yes, so that would be a cash outflow in financing activities, repaying the loans, or buying back your shares, you are paying the cash back to the shareholders.
Yeah.
Dividends paid, cash outflow. So again, so all these are outflows. So you've got to look at what's happening with the cash.
Yeah.
As to whether it's inflow or outflow. So you've got to, that's why we sort of focus more on the story. What story is it telling with inflows and outflows with investing and financing activities? That was good. That's a good comment. No other questions? We're almost out of time anyway. Karen, I can see you on screen. I'll just go down the campuses. Are you all good in Cairns? Thumbs up. Excellent. I can't see anybody else on screen, sorry. Townsville. Mackay's got me, so you're all good. Martin in Rockhampton.
How's Rockhampton going?
Good, good. Is this your favourite financial statement, Maria?
Oh, how can you tell? It is.
Maria loves cash. She just loves cash.
You're very happy.
Yeah, I do love cash. Look, I was just having a conversation about cash with my children because we're taking them to New Zealand and we're taking them skiing, and I was trying to let them understand the concept of saving but then spending. And one of my children commented the amount going skiing for one person is not too bad, right? It's about $250 per person. But when you take 4 children over plus 2 adults, suddenly you're looking at spending over $1,000 in a day. And so, you know, they were commenting on the value of cash and how we get cash. So I had a really good conversation with my children. And when I was presenting on slide 4 today, reading out Martin's study guide, cash is central and critical to business, just as it is in our personal lives. This is why being able to manage our personal finances well is so freeing. And I was trying to tell them that, like, if you can manage your personal finances, it's a life skill. And so I think that's why it's so dear to my heart, because it's not really something that I was taught at school. It was something I learned, I guess, from my parents. And so I'm now, you know, trying to teach. And we're sort of trying to get you a perspective on cash in the lecture today. But if there's anything that you take out, that component, that little sentence from Martin's study guide, I thought was classic. I love it. I'm actually going to read it out to my kids when I go home. So, you know, cash is central and critical to business, just as it is in our personal lives. And it really is. That's such a fundamental statement. So, yes, I do love the statement.
She does. And, you know, Maria, she reads bits of the study guide to her children at night. Isn't that extraordinary?
Bedtime stories, right? Okay, keep going down. Bundaberg?
Yeah, we're all good, Maria.
Oh, thanks, John. Where am I? Brisbane, Sydney, and then Melbourne. All right.
Yeah, we're good in Brisbane. Thanks, Maria.
Thanks, Lois. Sydney and Melbourne, are you all right too? You've got tutors there.
Very good, thanks, Maria.
Very good. Okay, well, that's it for me today. So you'll have lots of fun in your workshops now. Shout out to the exam advice too, which is, I noticed Martin has released that already on Moodle. So you might like to use that in conjunction with your workshop work for this week's work as well. So have fun, and I won't be lecturing for the remainder of term, so I'll see you online with all the questions. Thanks again.